Hey everyone, this is Devin Moreno and welcome to my real estate investing channel. And today I wanted to go ahead and talk about a question that someone asked on the channel asking what would I do with $20,000 if I have that money today, and that's what I'm starting off with. How would I purchase my first deal? And actually I met a couple of investors who also watched the channel, and they said collectively amongst them they have $30,000 and they just want to know what exactly they should do to get their first property. Now, I wanted to combine this with another topic, which is creative financing. There's often this word, creative financing, thrown around in the real estate world, and it's often this kind of strange thing because no one seems to talk about it. What exactly is creative financing? And so what I wanted to do is break down what exactly that means, because it's actually a little bit more of a broad term. There's nothing you can, you don't go to a bank and say, hey, I'd like some creative financing, or, talk to an investor or lender who specializes in creative financing. That's not a thing. So I'll explain what creative financing is and how that relates to what I would do if I only had $20,000. So let's go ahead and get into it. So I'm going to skim over a first couple examples of creative financing, what you could do with such a low amount of money, because unfortunately $20,000 or even $30,000 is considered a low amount of money in the world of real estate. You're going to need a lot more than that, even if you're going to deal with properties in Baltimore, which, as you may know, I invest primarily in Baltimore, and that's because as a new investor, properties are cheap in this area. Anything outside of this, and you're going to be looking at houses that are well priced outside of your range. So this is a great area to take advantage of these cheap prices and then practice renovations and your skills and maybe a little money on the side. So the first creative financing strategy is actually house hacking. This one I've talked about in several other videos, which is essentially using a primary residency loan in order to make a loan down payment on a house. So in the case of your $20,000, let's say normally you would want to buy, let's say, a $90,000 house. Why is that? Well, because you would generally, with conventional financing, have to put down 20%, and you don't want to do necessarily a $100,000 house because you still have closing costs and all the transfer taxes and everything that go along with it. So reasonably, you're restricted to about a $90,000 house if you use a conventional loan to purchase the house. Well, with a house hack method, you can live in the property, which you would for a period of like 6 months. And there's many different ways to structure this, with whether it's a rooming house or Airbnbs or whatnot, but essentially you live either in the house or in a part of the house, and this would allow you to afford a $300,000 home, because then you would only have to put maybe 5% down on the house, sometimes even less, 3%, or in the case of my VA loan that I had access to, it was 0. So now obviously this method is not for everybody, but because obviously you have to live in the property, so if you have kids or a wife who won't really be along with that, then that can become problematic. Remember, I say live in the property. This can be your primary residence that you live in, but you're going to move out 6 months later. I mean, pretty much you'll have to be a little bit creative on that. Obviously, you really actually want to live in the property. You do not want to commit mortgage fraud, so don't do anything like that. But this is a way to expand how far your $20,000 can go. Now, keep in mind, you're going to have to rent the property differently because you will be highly leveraged on the property doing this. But I have gone into that in other videos, and I will post a link down below in the description to tell you, okay, different ways you can take advantage of a house hack. Now, the next most common creative strategy is using a hard money loan. Now, after this, it gets into a lot more tricky strategies and such, but a hard money loan is where you get a hard money lender, and these are just simply lenders who put a lien on the property, so they, have a hard asset that they put a lien on. That's why they're called hard money lenders. And so basically, they will fund everything for you as long as you maybe put some money up front to get some skin in the game, I guess you can say. So they may ask for that $20,000 as like a down payment, and then they fund the rest of it. Now, this is probably one of the most common ways you're going to be getting your first property if you have absolutely no experience, because private lenders, whom are just simply random people out there, may not trust you. You don't have exactly any experience. So hard money lenders, though, however, are used to looking at the deals and know when a deal is good. So you're going to have to do your research. You're going to have to understand the concepts behind ARV, cash out refinancing, how exactly that works. What are your rental rates after you cash out refinance and have this new loan? What are your, I mean, obviously you can also just sell the property, but we're talking about buy and hold investors here. So I'm not going to be talking about any flipping or wholesaling in this video. But reasonably, you're going to want to know how you can get this hard money lender paid back after all the renovation work is done. You're going to need to know construction costs. There's a lot that goes into this. So if you do not know your numbers very well, remember the hard money lender will know your numbers. As soon as you present them the property, they're already going to know all the math you're working with. So really, it's a test to see if you know what you're talking about. So if you don't, then they probably won't lend to you. Even if they do lend to you, you need to make sure you understand the math behind it. Oftentimes, a hard money lender will charge a lot higher interest rates than a normal bank, 12 to 15%. Also, they're probably only going to let you hold the loan for a brief period of time, maybe 6 months to 2 years. They're all different. I mean, each one will work with you a little bit differently, but you're going to have to get rid of that interest rate by refinancing the property under a conventional loan. And you would do this by having a lot of wiggle room in the cost from the cost that you're purchasing and the actual ARV of the property. Now, I would go into this in other videos, but in our cost breakdown videos, you can see how we kind of do the math behind this. So that is one way I would do it. I think if I were to go at this, I'd probably try to find like a $55,000 property in some of these kind of Class C neighborhoods in Baltimore City. You can find them probably like Bel Air, Edison area actually is where I met some of the investors who were talking about this. In that area, you can find cheap properties that you can do a renovation on. The ARV will be like $140,000, and this will be perfect. If you put like 40 grand into it, you get 70% of that ARV and all in cash, and that's what allows you to pay your hard money lender back and with all the money he gave you for the renovation and everything included. So that's basically the quick breakdown, but let's go into a few others that are a little bit more rare and weird for newer investors. Now, I must confess before we get into these other four that they are rather unconventional ways of buying a house that I have not actually used before. Because I could take advantage of the first two creative financing strategies, which is hard money loans and house hacking, I've never had to use these other ones, but I absolutely would use these other ones. And I think you should know how they work. So they are rent to own, subject to deals. Then you have seller financing and then partnering with the seller themselves. So let's go into all four of those and what exactly that means, because many of these don't really require you to have any money in the deal at all if you actually do it correctly. So the first one we're going to talk about is rent to own, also called a lease option. Now, with the lease option subject to and seller financing, they're all going to sound the same. Probably as you as a new investor, you're probably going to think they all sound the same. I want to try to simply break this down on exactly how you, what the main differences between these are. So rent to own means that you absolutely do not have any ownership of the property. You're just simply renting it with the option to buy it later on. But that option to buy it later on is key because it prevents the seller from actually selling it to anybody else. So with rent to own, you are renting the property, so you're probably doing it at market rates, which means you're going to have to figure out a creative way to rent the house at a higher value than the average market rate. I think the most common example of this is a rooming house. So maybe I might go into an area like Fells Point or Hamden area and then use the rent to own strategy with the owner and then rent the house sublease essentially to a rooming house sort of situation. You're gonna get a lot more money in a rooming house than you will renting it as a family. The only problem with this strategy is that you don't own the house, which means you can't renovate anything without permission, and you can't rent it to anybody else without permission. So you're gonna have to get the seller on board with this one, but if you manage to do it, you can come out of pocket almost nothing. I mean, essentially, you're just renting the house. So, I mean, maybe you have a $2,000 option fee, which would be forfeited if you didn't buy at the end of the term. And that term could be, 2, 5 years. It's variable. It depends on you and the seller. But this is a way where you can at least control a property before you actually have a chance to buy it. And this will give you maybe experience in renting, maybe even renovations, if you're allowed to actually renovate the property. So this is just one option. Let's go into what a subject to deal is. Now, a subject to deal means that you actually own the property this time. This subject to and also seller financing is where you both own the property, but those two have very, very distinct differences. Subject to means you are taking over the payments of an existing mortgage on the property. So that means if their mortgage payments are already a set amount, you now will take control of that without telling the bank. So this is very commonly you're doing this under the table. The bank has no idea what's going on, and technically it's a sale in a sense, so technically it can trigger the due on sale clause, so make sure you understand how that whole process works. But in this case, most of the time, the bank really doesn't care who's making the payments, just as so long as the payments are being made. Now, the beautiful part about this strategy is the fact that there's absolutely no fees. There's no like broker fees and sale costs and all the bank fees and everything that comes into the whole process of getting the loan. It's also very, very fast. Obviously, it's just a quick contract. I obviously would write this up with a lawyer, make sure you've absolutely done it correctly, but there's really nothing, realistically, as far as upfront costs. Now, even if there is an upfront cost, oftentimes it might be a thing where, a lot of the owners who do this are often in foreclosure or have back taxes or owe some payments. You just catch them up really quick, and oftentimes they'll agree to this deal. That's probably the most common way I've seen that this option subject to is done. As far as other ways that this is done, you can maybe pay a little bit of a fee up front just to give them that incentive, because you are having to convince them to get their money later, not now. So sometimes you might increase the purchase price in order to actually do this. So there's going to be a little bit of negotiation involved. But you can find a lot of deals, even in the investing world, where the person doesn't really need the money up front, and you can do a subject to, so that way they can just take over the payments. Once again, though, probably the most common is you're catching them up to current payments so they can avoid a foreclosure. The most important thing to note about this is it's not a loan assumption. So if you type in loan assumptions into Google or try to research that, a loan assumption means your name is now actually on the mortgage. In this case, your name is not actually on the mortgage, but you are on the property as the owner. So you do actually get recorded on the deed. So that is just a big difference here. Loan assumptions you generally can't do in most conventional type loans. You can do them with VA loans or FHA loans, but in the case of most loans, you probably won't actually put your name on the property. If you control the property for a long period of time, then you probably will give yourself some time in order to actually refinance the loan and get the seller paid off completely, and then you resume as normal with the property you've already been renting for the past 2 to 5 years. Now, with seller financing, the main difference between this and subject to deals is that you still own the property, just like a subject to, and unlike the lease option. But in this case, there's no mortgage on the property, or at least there shouldn't be. So you're not taking over any payments at all. You're just basically allowing the seller to become the bank. Essentially, the seller is agreeing to finance the property for you. So let's say that the property is going to be worth, $100,000. Well, they may want a down payment. Generally, it's going to be cheaper than a bank, like 5-10% instead of your normal like 20%. So there you go. You have the money to do that. And then you essentially work out a deal where you pay them over a course of period of times, and maybe there's a balloon payment clause in there. A balloon payment is when you can stretch the payments over the course of 30 years, but at the end of 5 years, they can just call the entire loan due. So realistically, you're actually paying it off in 5 years, but you're amortizing it over a course of 30 years. So just to make the payments smaller. So basically, they may charge you some fees, generally like, let's say 5%, or maybe it's, 8% if there's no money down. You can work out a bunch of different negotiation tools, and I'll probably do an entire video just simply on seller financing. But essentially, yes, the bank becomes the seller. The seller, becomes the bank, and they're the one financing the property to you in the similar way a bank would. Of course, there's no closing costs. There's none of that other stuff that you got going on. So you're waiving a lot of the fees that come associated with actually buying a property. Now you might wonder how common this is that a seller would own the house free and clear, but actually nationwide, 30% of all homes are actually owned free and clear. It's actually a larger majority than people think. Well, not majority, but it's a larger minority, I guess, than people think. But in Baltimore City specifically, there's actually quite a lot of homes that are owned free and clear. There's a lot of people who have lived in their house for a long period of time. So this is something that, if the seller's not really trying to get their money all up front, or once again, you can increase the purchase price to, make the seller happier with this idea of selling to you later, then these are a lot of different options that you can discuss with them in order to buy the home outright. Now remember, all these three different options require some negotiation. I think the lease option probably requires the least, but gives you the least advantage as the actual buyer. So, but just keep in mind, these are there. Subject to deals and the seller financing, you own the property, but one, you don't have a mortgage, or the seller doesn't have a mortgage, which is the seller financing. You do not want a mortgage. Make sure you have a title company. Make sure there's no back taxes and no mortgage on there that's going to surprise you. And then, of course, subject to is there is a mortgage, but you're just taking it over. So that's just a recap on those. And then the final one that we got to go into is partnering with the seller. So in partnering with the seller, you actually are turning them into an equity partner in your flip, I guess you can say. And like I said, this is not about flips or wholesale. We're talking about holding the property long term. But let's say the seller has a distressed property that, if renovated, would be worth a lot more money. But the problem is they don't know how to renovate, and they don't want to deal with contractors, and they don't know what they're doing, so they're selling it for a low amount. But maybe they have a mortgage on it. Maybe they just can't sell it for that lower amount because they simply just owe too much on it. Well, if you do the math on it and notice that the ARV would not only pay off the seller but also make profit, well, then you can put them in a situation where you can say, all right, I'll tell you what, you put it under contract and make sure they have to sell it to you within a very short period of time after the renovations are done, let's say 4 months. And then essentially you renovate the property for them. Maybe you front the costs for just the rehab, and that's it. And that's where your $20,000 can go, or your $30,000. Or maybe you can even convince the seller to even pitch in with that with you. And essentially, the way you can do that is maybe at the end of it when you make the profit, and the profit would come from a cash out refinance. So let's go back into that example I had talked about earlier. Let's say the property's $50,000 right now, essentially, and that's all the best you could do with it. But if you put $40,000 worth of work into it, then it would be worth $140,000. Well, at the end of that deal, or maybe it might be worth more, maybe $180,000. Well, at the end of that deal, if you could do a cash out refinance, you're going to have some spare money left over. And in that, you can basically negotiate with the seller and say, hey, look, you'll get a minimum amount of profit of, let's say, 10 grand, or maybe not just a minimum, but you maybe also get a little bit extra into the deal. So maybe a certain percentage of the profits plus the minimum. You can work this out in a couple different ways where the seller will make profit from you flipping the house. Well, remember, I'm saying the word flip, you're not selling it. You can sell it to try to get more money, honestly, if you really want to, if that's your goal. But ultimately, as a buy and hold investor, you can just do a cash out refinance, assume control of the entire property, and then there you go. You didn't have to really use a lot of money in order to do that. And once again, in Baltimore, there's a lot of homes where they just can't sell the property. They want to, but they can't sell it because the current mortgage they have is more than what the property is actually worth at the current state that it's in. So those are my 6 different creative financing strategies that you should use if you have a low amount of money. I mean, I could talk about in future videos where exactly I would use those. I'll get into more detail about each one specifically and how to actually structure them here in Baltimore City, or even just, I guess, in the state of Maryland where I invest. So if you have any questions about those options to you as far as what creative financing is, hopefully I've demystified what that is. All of this is creative financing. It's just different methods of doing this. But let me know if you have any questions below, and I'll talk to you all very soon.